The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk, and it is possible to lose principal and interest when investing in securities. No strategy can guarantee a profit or prevent a loss. The views expressed represent the personal opinions of the presenter or featured guests, not necessarily those of USA Financial or its affiliated subsidiaries. Any opinions or forecasting statements are subject to change at any time and without notice. John Cyndia is an investment advisor representative of, and advisory services are offered through USA Financial Securities Corporation, member FINRA SIPC, a registered investment advisor. Life Stages Advisory is not affiliated with USA Financial Securities. Life Stages Advisory, Dean or Remington, or any guest we have are not affiliated with USA Financial Securities. Welcome to episode 72 of WTF, Wealth, Tax, and Finances. I'm your host, John Cyndia, certified public accountant and personal financial specialist. I have Remington and Dean in the studio today.
Hello.
Hey, guys.
How are you doing, John?
Good. I hope everybody was getting used to, relaxed COVID issues and everything. People going out.
Yeah. At least in
fun.
Ohio. I'm not sure about the other states. I haven't done any
Ohio, I think, is almost
research.
100% back to normal.
Yeah, but I don't
Full
know.
restaurants.
Yeah, I went out just over the weekend just shopping for some job interview clothes, and mall was packed.
Oh, really?
We got in and we got out. Didn't say anything to anybody really. We just did our thing, but it was like shoulder to shoulder almost. It was,
Really? Jeez.
It was weird.
See, I don't go to the mall.
Ugh.
I don't go to the mall.
I don't go much anymore.
I don't
All
go anywhere.
All the stores.
Either my wife buys the stuff for me, or if I really want something, I'll go in and I buy it. I don't know what it is, but I'll go in and buy it. I know if I need a shirt, I got a certain type of shirt.
I've just gotten so used to shopping online. Going to the mall, I felt like I was in a zoo. I didn't know what to do.
Yeah, it's crazy. So I think what we'll do today, we're going to talk about DRiPS, Dividend Reinvestment Programs. We touched on it a bit before in one of the previous episodes, but I wanted to get a little bit deeper into it because I've been dealing with a lot of the clients lately and getting them into more dividend stocks because they're getting closer to retirement. And we're starting to look at income producing and distributions instead of accumulation. So, you've got 20, 30, 40 years to accumulate, and then we're starting to transfer and reallocate what we're doing into more of an income producing and more of a situation where we want to maintain our net worth. So it's going to be on a situation where we're going to generate some income, but we want to maintain our basic structure and our core assets, okay? So by doing that, we get into more dividend-paying stocks rather than growth. They still might have an upside to it. And I was studying and looking into just some articles in that and looking over the past history from 1980 until currently. I've seen that it's been 75% of the S&P's gains are from dividends.
Oh.
So when you look at that, you've got about 25 to 30% that is from appreciation, and the rest is from dividends being reinvested. And a lot of people say, oh, well, it's, I don't want a dividend reinvestment. I don't need the income. I don't need this, that, or whatever. But historically, the stock markets have averaged about 10% going back to 1929. So, and you have to figure out what the average is, So you can be all the way down to a minus 15 or a positive 35%. Average is 10, okay? So out of that, the dividends make up the majority of what those actual returns are. So if you look at it from a standpoint of just investing in growth stocks or mutual funds that do not pay dividends, then those are going to have to be traded constantly. And you're going to have gains, losses, you're going to have everything else in there. If you get a good steady core of high dividend reinvestment plans, And the dividend reinvestment plans, you can just have separate stocks. And there's a lot of the stocks that pay dividends will have that. And from a brokerage standpoint, we get them in the brokerage account, and then we just hit a button that says reinvest dividends. So you usually pay them out in cash. You can get a check. And if you're retired, as some of our clients are, they will take those out and utilize those for income. Now, if they're not, we're still doing the reinvestment, okay? And we've had some clients that have done so it's been 30, 35, 40 years. They've had these reinvested dividends. And, they're getting dividends on stocks, $95,000, $125,000, $150,000 a year just on dividends. Okay.
That's pretty crazy.
Oh, it is.
Yeah, I didn't know
is.
that you could. Well, I mean, obviously, if you invest in enough money,
Yeah.
you'll have dividends like that.
But even if you have that, I was looking, if you had like $100,000 back in 1980, it would have grown about 17 and a half times just from the growth. But if you had the dividend reinvestment, it was like 52.5 times it would grow. So you're looking at $5.5 million versus like $1.7 million. And that difference of over $3 million was based on the dividends going back in. And if you look at it, it sort of makes sense because dividends get paid out normally quarterly. There's some of them that pay out more frequently or less frequently, but normally it's quarterly. And you just have to figure out, it could be on an April, July, October, January type situation. It could be on a February schedule, March schedule, whatever that is. So every 3 months, every quarter, you're going to get a dividend. And think about this. When it reinvests, the price is always going to be different. So it could be up, could be down. What's that sound like? We talked about that before. Dollar cost averaging. So as you invest, say $100 a month or whatever you have, market's up, you buy less shares. Market's down, you buy more shares. So that over time, if the market's going up, you can actually have the market pull back in some cases. And if you bought a lot while the market was down previously, and the market has a little increase, and it pulls back, you could still be ahead and in a gain position, because it's going up and down and you're buying all through this.
But you're still up from when you first initially invested.
Exactly. Yeah. So with the dividends, if you look at that and you've got say a 4 or 5% dividend, and you do that for 10 years, you've got a 40 to 50% increase in what your original base was. The other thing is that the dividends, normally when we look at those, we try to get companies that have had stable dividend payouts for at least 20 to 25 years minimum. But we also look for increasing dividends. So they increase the payout. So they may raise them 2, 3, 4% every year. So now you've got an increasing dividend payout. So from their free cash flow, from their earnings and their revenues, the more profit that they have, the more they will increase their payouts. So you had something that maybe it was at a 3.5% rate. You've got an increase on the stock price itself. It's being reinvested as it's going up and down. And then you turn around and next year they have a 2 or 3% increase. So it's an increase off of what you originally had. But if the price is up, the actual percentage is down. If the price is lower, and the dividend rate's higher. So there's a constant dynamic that's going on here, that once you buy into it, that's where you're sort of locked in at whatever percentage that is. That's why we had some clients in some industrials that were selling around $60 a share, had a 5.5% dividend. Well, now they're up 250%. They're around $200, $180 to $200, and their dividend is like 2%. Well, they've had an increasing dividend, but the price is so high. In relative terms, you're still making, whenever you bought it, you're still making 4 or 5%. But you've got this huge increase. If you buy in now, the dividends at 2%. Okay. But the thing is, when you're doing a reinvestment of these, of the stock dividends, you're buying more of that stock. You've got the increase of that. You have the increased dividend. And over a period of time, you're just building this wealth that, you let the market take over. And it's that compounding that we talked about before. So we've got dollar cost averaging, we got dividend reinvestment, and we got compounding of the dividends. So once you have that, you've got like a triple threat going on there that's pretty slick,
Yeah.
So when you start thinking about it and people sit there and go, well, it's only a couple percent or whatever, that percentage makes a big difference. And if you can find these stocks that are doing that at 3.5%, 4%, 5%, which they're still out there, and I've still got clients, that we're investing in doing that, it makes for a very compelling core, I guess, if you want to look at it that way. And the other thing is, if you start looking at that 10% average of the market, if you got a 3.5 to 4, 5% dividend, you don't really have to earn a whole lot off that stock, from an appreciation standpoint.
Because you really only need a few percent.
Yeah. And once you start looking at it from that standpoint, and you've got maybe you bought it, there was a pullback. I look at the situation that if we've got a pullback in the stock market, I'm looking for a new entry point. I'm not trying to time the market per se, because I'm looking at it from a standpoint to gain a nice percentage payout, but then also buy that stock at a better price or value than it is currently. And there's a lot of industrials right now that are super high. They're great stocks, but we're not looking at them at this point to get into.
It's like an entry point.
Yeah, because there's, like we keep saying, there's going to be an adjustment. There's going to be a pullback here, and I'm looking for that entry point, as opposed to just saying, hey, let's get in and then write it down and write it back up again and all that stuff. I just never, I don't see any, reason to do that. If we leg into it a little bit, maybe we can take a little piece on a pullback, but I'd like to see that 10, 15, 20% pullback and then get into these, because they're infrastructure plays, they're industrial, and with the new administration, they should be good stocks going forward, like we talked about with some of the precious metals, in the last episode. And that, so you look at these infrastructure stocks, the industrials, what areas, the technology, what areas are we going to be, going for in the near future, and then, long term. And if you can find those stocks that have some type of a dividend payout, I would say, let's go for it. It's just like, the cryptos don't pay anything. Gold doesn't pay anything. So, you can't rely on gold, in retirement. It's maybe an inflation hedge, but you can't rely on that for anything to produce income. Same with cryptos. So you're going to be in an accumulation phase with those. There might be something else to protect against, inflation or whatever. So it's a different dynamic that those investments will offer versus what we're looking at from dividends from the stock market. But have you guys done anything on your 401k plans, like with dividend reinvestment or anything that way? Do you know if you have any high equity, high dividend?
I don't know if I do.
Okay.
I know we had briefly discussed my plan.
Yeah.
And I don't believe that I have any dividend plays in there. I have no idea.
Now the other thing is that on mutual funds are a little bit different. So you don't even have to have a dividend or a stocks that are paying dividends. The mutual funds themselves, because of the managers that trade, and it's usually between, I'd say, November and December is when they'll take profits. If it's been a good year, they'll take profits, and then you're going to have short-term and long-term capital gains, and there may be some dividend stocks in there that pay some dividends, okay? So you may have that, and then normally you have the ability, when you invest in these, to reinvest those dividends. And usually what we end up doing is we reinvest any of the short-term gains, long-term gains, and any of the dividends. So we try and reinvest everything so you have that constant buildup in there. So there again, it's a dollar cost averaging. And a lot of the growth stocks, it may only be once a year. It's usually going to be toward the end of the year, and that's usually when they'll take their profits. And there was 8-10 years ago when the markets weren't doing well, they weren't taking anything, and there was very little, if any, dividends or reinvestments or anything that they took because they were down, and they figured they'd hang on to the stocks. Well, they wait until the next year or two, and then all of a sudden you have this huge influx. People are wondering, their portfolio's down, yet why do they have all these gains? Well, it's been an accumulation for several years, and then they finally took the activity out of it, and the people are like, well, my portfolio's down, and I'm still paying taxes and stuff, on a non-qualified account, not something that's in an IRA. So if you've got something in IRA like on your 401ks and they're tax deferred, it's an ideal situation, whether it's they're paying out interest or dividends or whatever, it's all getting reinvested and it's not giving any tax consequences. So that's the other thing to look at too, because on a non-qualified account, just regular brokerage account, if you have dividends paid out, you'll at least get the advantage of the lower tax rates, 0, 10, 15, 20 at the highest, versus anything coming back out as ordinary income if you're on your IRA or 401k. So, there's different things to look at there depending on, the types of accounts you have and where you're going to put these, the dividends for the reinvestments or whatever. And so you have to think a little bit strategically sometimes too, where you're going to place that. So.
Yeah, I did some research. It was probably a little over a year ago because I was curious about the whole dividend process and like what to look for. And, just trying to find a stock or an investment strategy that has a good paying dividend. One of the big things that you had mentioned to look at was that it's growing over time. And usually if a dividend's going down, that probably means the company had a dip or something happened, so yeah, it's just, things to look at, but I mean, that can be a really smart play, like you said, from the whole compounding interest thing. And good info.
And there had been, 4 or 5 years ago, there were some of the automotive and cigarette companies that had, huge dividends. Well, a lot of the automotive went to zero. So all of a sudden, you saw them lose a lot in value because people just exited. We had clients that were in a couple of the manufacturers and stuff, and we pulled out, and they continue to go down. So we had a pullback of a little bit, but we got out before the major drop went in. And you still have the cigarette companies that are paying, I think some of those are in excess of 6% dividends. Now, how long are they going to be able to last with that? With everybody, not smoking, or at least the advertisements not being on air.
All the alternatives and stuff that are coming out too.
Like vaping and all that other stuff too.
Well, the majority of the cigarette companies have a big stake in the vaping side. So it's like if they've got that, they're making that transition too. So it's like the automotive companies going into electric vehicles.
Right.
So they've got to stay up with the stuff,
Gotcha.
So from a technology standpoint, I guess, how technical is a cigarette? But I guess it is if it's being vaped, So
very
you gotta,
technical, John.
Yeah. So you got to sit there and say, okay, do I need a chip for my vape pen? I don't know. If you don't,
probably.
Then, there may be, but maybe only one. You don't need 300 of them like the cars do, I guess. So you shouldn't have a backup in your vaping stuff. I hope not either. Let's see. Anything else that you can think of that you had questions on or anything from that? But I think a dividend reinvestment plan, or go back to look at your mutual funds, whatever they pay, have those go back in and do a reinvestment of those, especially if you're not utilizing them as income. Once you start utilizing them as income, that's a different story.
Yeah, and I think most people, my grandfather had bought me and my brother a couple shares of some stock a while. It was probably in the 90s, and they had that specific stock had a a dividend, and it would pay out. He bought us like 5 shares each, just like a gift.
Oh, okay, yeah.
And the dividend would pay out be like $4.
Yeah.
Quarterly. So we'd get like a check, a couple times a year for $4. And I would always wonder, I was like, oh, I don't know what this is. I thought it was cool. And then I realized, like, after cashing the check 50 times, I was like, it'd have been nice to just, like, have another couple shares of said stock.
You could be retired by now.
Yeah.
If you'd have done that, that's duh. You can't go back and do that again.
It's too late now.
But, well, hopefully this was helpful. We want to thank you for tuning in again. And, oh, my God, Remington, what do they have to do?
Buddy.
Whoa, where can they email?
Yeah, we got to start there.
Okay. Email me at jcindia@lifestagesadvisory.com, or
you can find us on YouTube, Wealth, Taxes, and Finances with John Cindia. Give us a like, subscribe, share, send it to your mom.
You can also find us on the normal podcasting platforms, Spotify, iHeartRadio, Google Podcasts, Apple Podcasts.
He's got his radio voice on.
Oh, yeah. You can tune in.
You can tell this is not scripted, right?
Oh, no.
Well, delightfully it is. We've been practicing this.
Oh, yeah. Yeah, we've been practicing, but as far as being totally scripted and saying, don't say that or don't say this, we have to look at each other and go,
the eyes.
Oh, yeah.
The eyes, it's like, give the old stink eye there. All right, well, until next time, thanks again, and we'll see you soon. Bye.